Hello everybody, William Jordan here. Sorry about there, it's like 3 o'clock in the morning, okay? Before going into the different candlestick patterns and formations like I promised you guys I will. Don't worry about it. There's something that I need to clear up first of all in this video because somebody actually asked me the question yesterday and I'm actually surprised by the amount of people that do not understand this. So basically the question was, how do you make money off of a stock as the price goes down? So I had to go through the whole process of explaining short selling, the differences between long and short positions on a stock, etc. And I know for many of you out there, you do understand it, but if you're one of those that do not understand what short selling is and the differences between long and short positions, do not worry about it, okay? We all have to learn at some point. Somebody had to teach me at some point how do you make money by going into a short position. I try to explain it to friends and family every now and again, and a lot of them still don't get it. Now, I'm not going to go into the more technical, complicated things behind it. I'm just going to try to keep it as simple as possible for you guys out there without going into the whole margin, leverage kind of thing, etc. Okay, just keep it simple. I'm going to try to explain the differences really quickly so that you guys can understand more when we do get to the candlestick patterns and formations and use it in your trading strategies. Okay, so what does it mean to go long on a stock? Now, basically, it means you're buying a security, expecting the price of said security to go up and selling that same security at some point in the future. Now, this process, for most of us out there, it's the process we're most familiar with, and it allows you to pocket the difference between your purchasing price and your selling price at some point in the future. Now, the reason why we're more familiar with this process is simply because for most of us, it is the more traditional way of doing business. For instance, imagine buying a property, buying a house. You're investing in real estate. Now, unless you plan to live in that house for the rest of your days or keeping that property as a rental property and earning money from it that way, you're actually buying the house, expecting the housing market prices to go up and then selling that house for a profit in the future at some point, okay? Now, going long on a security is basically the same thing. You buy into the security, and after an increase in the security's price, you sell it for a profit at some point in the future. Now, as you might expect, there's a certain amount of risk involved in this traditional way of doing business. For instance, imagine that you buy a stock, you enter into a long position, and instead of the price of the security increasing, for some reason or the other, it actually decreases or it drops. At that point, you're actually losing money on your investment, and you need to get out of that position by taking a small loss to prevent bigger losses further down the road. Now, I know there are many different reasons for buying a security, okay? There can be the dividends, there can be many things to do with the company, the holding period. There's many different reasons why you would like to buy a security. But like I said, for explanation purposes, I'm just trying to keep it as simple as possible, okay? So, let's recap quickly. Okay, so imagine yourself buying a stock at $20 a share. And you expect the price to go up since you did your homework really well, etc. Now, everything is going according to plan, and at some point or the other, the stock price actually hits $30 per share. Now, you're really happy because going from $20 to $30, that's a $10 increase, but that actually gives you a 50% gain on your initial investment. $10 is half of $20. Now, this is really good, and you're happy, you cash out at $30 a share, 50% gain. If things can go on like this forever, you would be really happy and you would have your whole future planned out ahead of you. Now imagine yourself buying that same stock at $20 a share, and for some reason or the other, the price drops. And since you forgot to place your stop loss, remember your stop losses. We're going to talk so much about stop losses, okay? Let's go on. For some reason or the other, you cannot exit that position in time, and the stock price actually drops to $0 a share, okay? The company goes bankrupt, the stock price drops to $0 a share. That is basically the worst thing that can happen to you with your investment. You're losing 100% of your initial investment. Excluding margins, leverage, etc., like I said, it's the worst thing that can happen. You place $20 on a stock, on a security, the price drops to zero and you lose everything, okay? So those are the basics behind a long position. Like I said, I'm not going to overcomplicate things. You buy a security, the prices go up, you sell that security at a future date. That's what a long position is. The worst thing that can happen is losing 100% of your initial investment. A short position is kind of different in a couple of ways. So let's get right into it. If a long position means buying low and selling high, then a short position is basically the exact opposite, selling high and buying low. So how does this work? Shorting a stock or short selling is basically the process in which a trader or an investor sells a stock at a certain price, expecting the prices to go down and buying that stock back at a later period in time. So how do you sell a stock that you don't own? Basically, it involves more than one party. Remember that you want to sell high and buy low to make money. So in order to do that, you have to borrow a security from one person, usually a brokerage firm, and you expect the price to go down on said security, and now you sell that security that you just borrowed. If you did your research well and the price does go down, you can buy back that security at a future date and pocket the difference. So going back to our previous example, say for instance there is a stock that is worth $20 a share. Now you think that the price of that stock is about to go down. You then borrow that stock and sell it at a price of $20 a share. Congratulations, you have just entered into a short position. Since you are still in the position, you didn't just earn $20. You have to buy back that stock before you can earn any money. Now the stock price drops to, let's say, $10 a share. You decide to exit your short position. What you basically do is you buy back your borrowed stock at $10 a share. Since you sold it at $20 a share and bought it back at $10 a share, you just made a $10 profit on a short position. Now, since you just bought back the stock, does it mean you now own it? No, remember you borrowed the stock from somebody else, from a third party, so you basically have to give it back. So technically speaking, you just made $10 off of a stock that you never really owned. The whole process behind short selling, it involves margins, brokerages, other parties, etc. And we'll get into all of that in future videos. But just to keep it as simple as possible, just think of it as shorting a stock is borrowing a stock from another party, selling it, buying it back at a later period and pocketing the difference. Short selling is a good way of making money when prices go down, but it does have some additional risks and extra costs involved. For one, if the stock you borrowed pays a dividend, you'll have to pay the dividend to the party you're borrowing from since you're not the owner of the stock. Short positions also charges, in general, an interest rate. You are, after all, borrowing a security and you need to compensate the other party for borrowing from them. This is the same way that the bank charges interest on loans. A lot of the time there is also buy-in risk. This is when a broker makes you cover your position prematurely. This happens oftentimes when the broker needs to return the stock to the original owner or if the stock sees a sudden surge in demand. Short squeezes are also common in the marketplace. So what are short squeezes? Imagine a heavily shorted stock, but for some reason or the other, the investors shorting the stock need to cover their positions by buying back the stock. This causes a sudden upmove in the stock price. More stops are getting hit, which further causes the price to surge even more, which would then make you lose even more money, even if your research originally was right in that the price should go down. This can be a very painful experience for traders and investors out there, and you hear them often saying that their entry price should have been at their stop loss price. By far, one of the biggest risks involved when shorting a security is the potential for price increases. Remember what I said for a long position. The most one can lose when going into a long position is 100% of your investment. That means that if you bought a stock at $20 a share and the price drops to $0, you lose your $20. But if you were in a long position and the price doubles, triples, or even quadruples, you can make many times more than what you put into the position. Since stocks theoretically have unlimited upside potential, your gains are potentially infinite. In a short position, this is basically the exact opposite and could end up costing you a lot of money. Taking out all the extra costs, margins, etc., if you short a stock at $20 a share and the price drops to $0 a share, you're doing pretty good. But think of if the stock price goes up. You're in a short position and there is infinite upside potential for the stock. This means that your losses theoretically can be infinite. This may seem a bit far-fetched for a lot of people out there, but the cases are not unheard of where people in short positions lose way more than they thought possible. Just look at what happened to GameStop earlier this year. Now, all this being said about shorting a stock, why is short selling even a thing? I mean, technically, you're actively betting against a company that is trying to push up its own value. First of all, shorting allows for liquidity and volatility. If you could only buy stocks and never sell them unless someone offered you a better price for them, stock prices would be so much higher than they are today. We won't be talking about million or billion-dollar investments. We would actually be talking trillions of dollars. Another thing is that certain companies, sad to say, are just not worth buying into. Some companies maybe used to be the next big thing when they created. For instance, let's talk about VCRs or fax machines. But over time they fell out of favor or didn't branch out into other goods or services, and hence they lose their importance or value. Now, if you cannot short a stock, people are stuck holding on to expensive shares no one would want to buy back from them. One can argue, of course, that this is the investor's own fault, but buying shares one day can be actually a good idea and it would even help out the company. However, if the company does go bad, holding onto those shares is a bad idea, and in many cases, not being able to sell the shares has the potential of putting many people out there into bankruptcy. At least if you can short a stock, you can make back some of your losses. I never said this is going to be a happy video, okay? So don't hold it against me, I'm just explaining out there. By far, however, the biggest value there is behind short selling is the ability for hedging. Hedging is a means of minimizing risk from a more complex set of transactions. Let's take as an example a wheat farmer. He's planting his seeds in the spring and he plans on selling his harvest in the fall. Of course, the farmer wants to make as much money as possible from his harvest, but he is subject to price risk. The price of wheat might be changing over time and it might be lower in the fall. So he cannot really allow himself to speculate on the price of wheat 6 months down the road. So what the farmer does when he plants his wheat is he goes out and sells the wheat on a 6-month futures contract at the current price of $40 per bushel. He's effectively taking a short position on wheat. This is known as a forward hedge. 6 months later, the farmer is ready to harvest and sell his wheat at the prevailing market price of $32 per bushel. Now, something happened that made the price of wheat drop from $40 6 months ago to $32 today. So he sells his wheat at $32 per bushel, and at the same time he buys back his short position at $32. This short position gives him an $8 profit. Plus, he sells the wheat for $32, so he still makes his $40 profit. The farmer, through hedging, essentially locked in the price of $40 when he planted his crop, where otherwise he would have only made $32 per bushel if he didn't hedge. On the other hand, imagine that the price of wheat went up to $44 per bushel. His proceeds from the sale of his wheat gives him $44 per bushel. However, he has to buy back his short position at a loss of $4. So he's still making his $40 per bushel. By hedging against price risk, the farmer has limited his losses, but at the same time he has also limited his gains. This was just one example of using shorts as a hedge in order to protect an investment. See this more as an insurance against risk. There are many other examples out there, however. For many, short selling isn't a good investment strategy, and trading is frowned upon a lot because of traders taking up short positions. Many times, market crashes and companies going bankrupt was blamed upon short sellers, and many countries now and again limit short selling or even outright ban it in certain situations. For instance, the 2008 economic crisis, the COVID pandemic, etc. Economic regulators seem inclined to restrict short selling to decrease potential downward price cascades. However, one can argue that this only contributes to market inefficiency. So what are your thoughts on this? Is short selling a good thing or a bad thing? Should it be limited? Should it be restricted completely, etc.? And why do you think the way you do? I would love to know. I hope I cleared up the idea of what shorts are and how to use short selling to make money and the differences between long and short positions. If you have any questions for me out there, leave a comment down below. I will be glad to answer them. If you like my content, remember to give me a thumbs up. I would appreciate it. If you're not subscribed to my channel yet, please go ahead and subscribe. It's free. This was William Jordan from the Moneymaker channel. Hope to see you all in the next video.